Good morning, everybody. Thank you for joining a Miller Johnson team today for our Tuesday, May 5th COVID-19 response team update. This morning's webinar will focus on recent developments and changes to the Federal Reserve / Treasury Department's Main Street lending program, which were announced late last week. Before we get into the presentation on the substance of the updates, let me first introduce the other presenters we have with us today. First is Loic, who is an associate in our corporate and mergers and acquisitions group. He also works in the finance area. And then Chelsea Austin, also an associate in our corporate department, has joined us today. Chelsea and Loic have been working closely together as the Main Street lending program terms were first announced on April 9th, and then refined 3 weeks later on April 30th. And my name is Erik Daly. I'm a member in our corporate and M&A group. I have, over the last couple of months now, I guess, been tracking developments under the CARES Act, which is the major piece of federal legislation, along with some of the prior pieces of federal legislation, the FFCRA and the two other bills, and coordinating across different groups within our firm to make sure that we're presenting a holistic approach and bringing solutions to clients and others in the community that represent a broad view of the different impacts of this legislation. So just very quickly, I like to start off all of our COVID-19 webinars just by reminding ourselves, at least the Miller Johnson team, that we're bringing our principles of collaboration, intellect, integrity, candor, and resourcefulness to bear on these problems, and trying to collaborate and cooperate with community members to help ease some of the difficulties as we can in our role as lawyers and community members by preparing and delivering these presentations. So I just think it's important to emphasize that at the outset as our starting point for everything that follows. And then another agenda item that we frequently cover on our morning calls is just a very quick rundown of some of the latest developments, news developments, or otherwise related to COVID-19. Something to note today in terms of statistics related to COVID-19. The worldwide death count from COVID-19 surpassed 250,000, I think yesterday. And in the U.S., deaths are tragically right around 70,000 at the moment, with about 4,000 of those occurring where we are here in Michigan. The Institute of Health Metrics and Evaluation at the University of Washington, which is one of the virus modeling organizations that's frequently cited, increased their prediction of infections and deaths ultimately in the U.S. from COVID-19 over the last couple of days. So while there are some signs of optimism and reopening of economies and things like that, there's also things to be concerned and, of course, clearly disappointed about, just in terms of public health and the toll that is taking. Turning to kind of legal developments, the Supreme Court here in the U.S. made history by hearing arguments by telephone for the first time and allowing people to listen in also for the first time, not in person. And then the U.S. Treasury is set to borrow about $3 trillion reportedly over the next 3 months to help pay for the CARES Act appropriations and other pandemic recovery efforts. And there's also large amounts of borrowing projected for the third quarter of 2020 as well. That will obviously have a longer term impact on the federal debt and interest rates over the long term. So something to continue to watch through the remainder of the year and beyond. And then lastly, many states on all different ends of this particular spectrum, some are still very much in a stay-at-home situation, but other states are starting to open up more and opening up more businesses. So it'll be interesting to watch as this happens in different flavors across the country, and to see what the ramifications and kind of best practices that evolve out of it will be. So, we know here in Michigan we've had some tensions related to decisions by the governor and how to phase the reopening, and different versions of that are playing out across the country. So we'll keep an eye on that, and I'm sure there will be lessons learned on both sides for best practices. Okay, so with that, why don't we turn to today's topic, which is the Main Street Lending Program authorized by the CARES Act. Here you can see today's presenters, and why don't we move on to the next slide. Just a reminder that these materials are really informational only, and they don't create an attorney-client relationship. To emphasize the first point and give a little bit of a warning. The terms announced by the Federal Reserve for the latest version of its Main Street Lending Program, while closer to final, I think, than the initial terms announced on April 9th, are still not entirely final, and we don't have a date yet by which the program is scheduled to go live, if you will, with banks originating Main Street Lending Program loans. So a further caveat there that there could be additional changes to some of these terms, or even additional borrowing facilities made available under the Main Street Lending Program. So let's go to the next slide, please. So just to set the backdrop, for this, the CARES Act authorized a significant amount of funds, obviously, for the Treasury, and some of that is earmarked for specific lending programs like the PPP, or the airline industry, or national security interests. When you strip that all away, Treasury is still left with, I think, a little over $450 billion in discretionary kind of spending, if you will, that they can use for economic stimulus or other purposes under the CARES Act. And one of the possible programs under the CARES Act is a partnership with the Federal Reserve to increase liquidity for different types of borrowers. And so on April 9th, the Treasury Department and the Federal Reserve announced that they would be creating a new special purpose vehicle, partially funded by $75 billion in initial equity from the Treasury Department. Out of that, a little over $450 billion authorized under the CARES Act contributed to this Main Street Lending Program, SPV, with the remainder of the funds coming from the Federal Reserve, and creating an ultimate amount of liquidity, around $600 billion, in order to purchase loan participations that qualify under the Main Street lending program. So that's really the backdrop here. Is distilled down to its simplest is the Treasury and Federal Reserve effectively funding loans that are on more favorable terms for borrowers that were in good financial condition prior to the outbreak, and then taking a significant, almost all of the risk of those loans, if originated appropriately, off the books of the banks that originated them and moving them onto the books of the special purpose vehicle. Let's go to the next slide, please. Under the original announcement from the Federal Reserve, there were two Main Street lending programs announced. One was the new loan program, and another was the expanded loan program. And both of those programs still remain in the updated terms. There is a third program now, which we'll get to in a little bit, but both of these original two programs remain, but with some changes to some of the key terms like the minimum loan size and a few other things, which we'll touch on. But the basic concept for the Main Street new loan program is, to provide new secured or unsecured loan facilities to eligible borrowers. And then by contrast, the expanded loan program is meant to provide an upsizing or an additional amount of borrowing available to debtors that have existing credit facilities in place, so that they can expand their borrowing capacity under those existing loan facilities. Why don't we keep moving to the next slide? Today's topic, as I've alluded to, about 3 weeks after they announced the kind of preliminary terms for the Main Street lending program, the Federal Reserve received feedback and sought feedback from banks, borrowers, other stakeholders about how to refine the terms and clarify open issues. So on April 30th, they released updated term sheets, a press release, and I think 18 or 19 pages of frequently asked questions about the Main Street lending program. And part of that, as I mentioned, was the inclusion of this new Main Street priority loan facility, the third option under the Main Street lending program. And basically, this third option provides, it's much like the Main Street new lending facility, except that it allows for more leveraged borrowing, basically. And it also allows borrowers who use it to refinance other debt. However, in order to originate one of these loans, the eligible lender or the bank would need to keep more of the exposure on its books instead of 5% remaining on its books. So the loan exposure would be about 15% of the loan exposure remaining on its books. So the SPV would purchase an 85% participation as opposed to a 95% participation under the priority loan facility. And as I mentioned, that could be used to refinance existing debt. So unlike the Main Street new lending facility and the expanded lending facility, this third option would allow borrowers to pay down existing debt using proceeds from the new priority loan facility, as long as there's a new lender coming in to originate that priority loan. You can't have your existing lender originate that priority loan facility to pay down debt to that lender. So it's an interesting new option that may be attractive to some borrowers if they are eligible after the underwriting process, and if the loan terms are more attractive under under this program than under their existing debt facilities. So with that, I'm going to turn it over for the next slide to Chelsea, who is going to talk about some of the changes to the criteria and just generally talk about criteria for eligible borrowers under all the different Main Street lending program facilities. Chelsea?
Thank you, Eric. So the new developments for the requirements for eligible borrowers shows that businesses not have more than 15,000 employees or not more than $5 billion in 2019 annual revenue. This is a change from the prior requirements, which said that businesses could not have more than 10,000 employees or not more than $2.5 billion in 2019 annual revenue. So when determining the number of employees, borrowers should count each of its and their affiliates, if they have any, full-time, part-time, seasonal, or otherwise employed persons as a single full employee. Volunteers and independent contractors should be excluded. Additionally, to calculate the average number of employees they should calculate the average number of employees over a 12-month period prior to loan origination or upsizing by using each pay period for that time. So again, the SBA regulations will determine that affiliation. Like I said, employees should count based on the 12-month average prior to loan origination or expansion, and revenue should be based on the 2019 GAAP compliant audited financial statements or the fiscal year 2019 receipts prior to the IRS, reported to the IRS. Next slide, please.
Can I just pause, Chelsea, real quickly on that? Sorry to interrupt. One question we had when they originally announced the Main Street lending program related to affiliation concepts, because that was such a kind of a hot button issue in the context of the Paycheck Protection Program. And it wasn't clear at that time, on April 9th, when they announced the program, whether they were going to require affiliation, and if so, what concepts would apply. So I found it interesting that they opted to essentially use the same affiliation criteria that are relevant under the PPP, except that the statutory exceptions for like restaurants and hotels don't apply, I believe, in this context. But otherwise, it's basically the same affiliation concepts. But on the other hand, they increase the number of employees and revenue. So I think overall, it's an expansion of eligible borrowers from the perspective of increasing the number of employees and revenues, but counterbalancing that is, this requirement to do the affiliation determination on a pretty broad basis like you do under the PPP. So just something I wanted to call out because it has been such a noteworthy issue in the SBA PPP context. Sorry to interrupt.
Oh, no, you're fine. We can go to the
Thank you.
Slide. Yep. So again, eligible borrowers may not participate in multiple MSLPs or participate in the Federal Reserve's primary market corporate credit facility, but eligible borrowers may participate in the PPP. Next slide, please. So ineligible borrowers, and this is as modified by the PPP rules and related SBA guidelines, businesses deemed ineligible under the SBA's business loan program and businesses that have certain support under Subtitle A of Title IV of the CARES Act are prohibited from participation. And generally, the SBA regulations would deem financial businesses primarily engaged in lending, such as banks and finance companies, life insurance companies, government-owned entities, businesses such as that, as ineligible. But there are a few limited cases in PPP guidelines that has relaxed certain cases of this disqualifying criteria. Moreover, businesses that have outstanding loans with eligible lenders as of December 31st, and such loans that do not have an internal risk rating equivalent to a pass, would be deemed ineligible. All right, we can move on to the next slide. So eligible borrower attestations previously there had to be certain included attestations to be compliant with these programs, such as borrower will comply with the executive compensation, stock repurchase, and capital distribution restrictions. Borrower will not use the proceeds of a program loan to repay other loan balances and will not repay debt of equal or lower priority until the program loan has been repaid in full. Neither borrower nor lender will cancel or reduce nor seek to cancel or reduce any existing lines of credit. Borrower meets the EBITDA leverage conditions. These were the previous attestations, and a lot of those are still the same, but there have been a few changes. So in the new developments, the borrower attestations include the borrower will refrain from repaying the principal balance of or any interest on any debt except for payments that are mandatory and due and other limited exceptions. This recalls that the eligible borrower may use an MSPLF loan to refinance any existing debt at the origination of the MSPLF loan. Sorry, that's a lot of letters. The borrower will not seek to cancel or reduce any of the committed lines of credit with the eligible lender or any other lender. We can go to the next couple of slides, or the next slide. Some more attestations. The borrower has a reasonable basis to believe that as of the origination date and following the receipt of the loan, it has the ability to meet its financial obligations for at least 90 days and does not expect to file bankruptcy during that period. Again, and also the borrower will follow the compensation, stock and repurchase and capital distribution restrictions. Those are also like the same from the previous directions and attestation requirements. We can move to the next slide. And one notable difference is previously the borrower would have to requires that the borrower is refinancing due to the exigent circumstances due to COVID-19, in that the loan proceeds would be made reasonable efforts to maintain its payroll and retain its employees during that time, again, due to the COVID-19 pandemic. This is no longer a required attestation. You can see at the last bullet point on this slide, it's no longer required to attest exigent circumstances resulting from COVID-19, resulting in loan need. So I think that is a pretty significant difference from the last rounds of required attestations. But again, now eligible borrowers are also required to exercise commercially reasonable efforts to maintain its payroll and retain its employees while the loan is outstanding.
Hey, Chelsea, on that last point, related to the omission of the exigent circumstances attestation, just again to briefly kind of tie this in with some of the developments under the Paycheck Protection Program, I think it's especially noteworthy that requirement was cut from the attestations, since there's been a lot of uncertainty and change in direction from Treasury and SBA in the PPP context about a not identical but similar requirement to certify some level of economic need. So it's interesting that they would omit that attestation here. There are differences, of course, between the loan programs. The main one being that this is not a forgivable loan for the borrower, whereas the PPP loan may be, and there will be some underwriting happening and financial assessment here. But the fact that there's no longer a requirement to attest that there's some kind of need resulting from COVID-19 is pretty noteworthy given what's going on in the PPP area.
Yes, thank you, Eric. So that wraps up my section on this presentation. I'll pass it over to my colleague, Loic to talk about eligible lenders.
Thank you, Chelsea, and good morning, everyone. Thank you for joining us. So just jumping right into it, the definition for eligible lenders here has been expanded. You may recall that it previously included lenders that were U.S. insured depository institutions, U.S. bank holding companies, and U.S. savings and loan holding companies. It did not include non-bank lenders and non-U.S. lenders, but on this turn, it has now been expanded to include U.S. branches or agencies of foreign banks, U.S. intermediate holding companies of foreign banks, and U.S. subsidiaries of any otherwise eligible lender. In addition, some of the attestations for the lenders have changed. Previously, the lender was required to attest that they would not request that the eligible borrower repay the debt owed by the eligible borrower to the eligible lender. And one question that arose when that first came out was to what extent would the program permit certain mandatory or required payments. And they've since clarified that there is an exception for those mandatory and due payments or payments that are due in the case of default or acceleration. Previously, the lenders were required to attest that they will not cancel or reduce any existing facility outstanding to the eligible borrower. There's now a clarification that they are permitted to, that they will not reduce or cancel any existing line of credit except following an event of default. So there's that leeway that's granted to lenders in that case. A new attestation here relates to the calculation of 2019 EBITDA, and really what's required here is that there be really an apples-to-apples comparison, and that the lender use the same methodology that is previously used for making this calculation for the eligible borrower or for borrowers and similarly situated situations for new loans. And then finally, similar to the borrower attestation, the lender must attest that the borrower satisfies the requirements for the program. Consistent with the theme that this program is really designed for borrowers that were in good standing prior to COVID, the new guidelines provide that the lenders must use their own underwriting scheme and standards, same standards that they've historically utilized for loans similar to these, and for borrowers similar to the eligible borrowers that will be requesting these loans. So the underwriters will again be able to use their own underwriting standards, be able to request their own set of documents, be able to use their own internal processes, and ultimately be able to deny or approve an eligible borrower, notwithstanding the fact that the borrower satisfies the other requirements outlined in the term sheet. With regards to changes to the actual loan size for the new loan program, the minimum amount of the loan has been diminished. It was previously at $1 million, is now at $500,000. As far as the maximum loan size, it's generally the same calculation. Maximum with the lesser of $25 million, or an amount when added to the borrower's existing outstanding and committed but undrawn debt does not exceed 4 times the borrower's EBITDA. One question that a lot of folks had when the program was first rolled out is whether this would be an adjusted EBITDA, or they would print adjustments to this EBITDA calculations, and that has since been clarified that it is the borrower's adjusted EBITDA for 2019. Again, going back to the previous slide, the methodology for calculating this EBITDA has not been clearly outlined, but so long as the lender uses the same methodology that they historically use for that lender or for similar lenders, they should be fine.
Loic, this is Erik. Really quickly on the point about kind of EBITDA being one of the, basically the key metric for determining maximum loan size under this program. One thing, and we may get to this later in the presentation, but it's worth pointing out here that this means that if a borrower has 0 or negative EBITDA, that their max loan size is going to be 0. The Federal Reserve did announce that it was looking at the possibility of other lending facilities under the Main Street lending program paradigm for borrowers that would be basically borrowing against assets as opposed to EBITDA, and also for not-for-profit borrowers who are currently not eligible to participate in any of these 3 programs. So that's one of those both of those are further developments to kind of keep an eye out for not-for-profits, how they might ultimately fit into this, and then for kind of asset-based borrowers, whether they might be able to participate in some form going forward. Sorry to interrupt.
No, thank you, Erik. Just moving on to the new loan program, the priority loan program, which in many ways mirrors the new loan program. You'll see the same minimum loan size of the $500,000. Now, similar calculation for the maximum loan size, the lesser of $25 million. But here it's been extended to, instead of being 4 times the borrower's adjusted EBITDA, it would be 6 times. So it provides for greater access to capital in that sense. And then finally, for the existing loan program, some changes here as well. The prior minimum amount was $1 million. That has actually been increased to $10 million. And the calculation for the maximum amount is the lesser of $200 million, up from $150, and 35% of the borrower's existing outstanding but undrawn bank debt. That is part through, in priority with the loan, an equivalent in secured status, or 6 times the borrower's adjusted EBITDA. And with that, I open it up to Erik to go ahead and finish us off here. Thank you.
Thanks, Loic. So just real quickly on the terms and conditions of these loans. The original interest rate was based on a kind of a potential LIBOR replacement rate. LIBOR is being phased out over time, and there was some discussion about what other interest rate might be, what other interest rate might make sense to use to kind of price the interest on these loans. And some of the feedback that the Fed received from banks was that using any rate other than LIBOR would basically be very difficult to implement on the time frame that these loans are hopefully going to be made available. So although LIBOR-based interest rates are gradually being phased out, they did include interest rate being tied to LIBOR, either a 1 or a 3 month rate plus 300 basis points or 3%. And I believe, just kind of calling back to what Loic said about banks using their kind of standard forms or their own underwriting, I believe that banks will have the discretion to include in their loan documents kind of whatever typical provisions they would include about substitute interest rates once LIBOR is phased out or no longer a viable option for setting interest rates. So that's kind of a noteworthy change in terms of the rationale for it. Economically, I'm not sure it really changes the evaluation of whether to participate in this program that much, but just an interesting change. And then another new term was announced that the loans can't be contractually subordinated in terms of priority to any any of the other borrowers' loans or debt instruments. However, you can have an unsecured Main Street Lending Program loan potentially, while also having a secured loan in place, as long as you're eligible or have the right borrowing basket availability. For example, if you have a secured lending arrangement in place and you have the ability to take on a new unsecured loan and you qualify on all the underwriting, you could effectively have that unsecured new loan be kind of second in priority to the existing secured debt, but it can't have a contract, like a subordination agreement to that effect. And then one other thing to note is that once the Main Street Lending Program loan has been incurred, the borrower may not have, they can't take on any new debt after that point that would have a higher priority than their new loan under the Main Street Lending Program. So there's some limitations on contractual subordination and taking on senior debt once you've got one of these Main Street Lending Program loans in place to keep an eye on. Next slide, please. Okay, the overall duration or term or maturity date of the loans haven't changed. Still 4 years, and there's still no payment required during the first year of the loan, although interest accrues. I believe it's just not payable until you get outside that 1 year period. And then they did include in their updated term sheets amortization schedules for principal repayment. So under the new lending facility, the Main Street New Loan Facility, the principal will amortize and be payable in 1/3 installments at the end of each of the second, third, and fourth years of the overall 4-year maturity. And then under the expanded loan facility and the priority loan facility, the other two options, again, no payments required during that first year, but the principal amortizes at a different pace. You have 15% due at the end of the second and third year each, and then a 70% balloon payment of basically all the remaining principal, 70% at the end of the fourth year. So those two loan facilities are kind of more back end repayment of principal, whereas the new loan facility is more even over time, at least over the second, third, and fourth years. Next slide, please. And then a noteworthy thing here, just really with all these government stimulus and lending programs, and this one is really no different, except that the Fed has, I think, been a little more proactive in highlighting that they are going to proactively and affirmatively disclose, among other information, the names of the participating lenders and borrowers, the amounts that they've incurred in debt, interest rates, costs, fees, things like that, revenues. So there's some, particularly on the revenue side, I guess, there's some potential disclosure of information for privately held companies that might not otherwise get out there. If you incur one of these loans, the Freedom of Information Act issues, to the extent that you're disclosing to the government any proprietary business information, should just be aware that it's potential that some of that information could be subject to FOIA requests, and there are the ways you can go about requesting confidentiality for more sensitive information. But the basic fact that you are a participating borrower and kind of what the terms of your borrowing are will be publicly available, and the Fed will be somebody won't have to file a Freedom of Information Act request to get that basic information. The Fed is going to be regularly putting that information out there in a way that's just pretty easily searchable, evidently, for the public. So something to be aware of if you do participate in the program. Next slide. And then these were some points of interest or points of clarification that I think the advisor, professional, and borrower and banking communities all sought after the original Fed announcement of the Main Street expanded loan facility or the upsizing facility. There were some questions around, whether the upsizing concept could be used with a revolving credit facility, and that was answered in the affirmative under the new term sheets, so that the expanded loan facility could be used to upsize a revolver, for example. And then maybe a more technical issue was in relation to syndicated loans with a lender group. There was some question about whether every lender in the group had to be considered a quote unquote eligible lender in order for the borrower to take advantage of the expanded loan facility. That was answered in the negative, so that you don't need every lender in the lending group to qualify as an eligible lender, although it would be easier to do so now, given that they've expanded the types of eligible lenders a bit. However, notwithstanding that, you really just need to have whichever lender actually provides the upsized portion of the expanded loan, or maybe multiple lenders, not clear. But whichever lenders participate in that upsized portion, they need to be eligible lenders. But the fact that you may have an ineligible lender in your kind of original lender group for the underlying loan facility will not disqualify the borrower or eligible lenders from upsizing. Next slide, please. So that's really all we had for today. There were, I think, the overall theme of the expansion of the Main Street lending programs is, the Fed did listen to market feedback to address some of the questions and concerns, and it probably didn't address every issue that is out there, but they did, I think, roll this out, if I could editorialize a little bit, in a way that differs pretty meaningfully from the way that the Paycheck Protection Program, for those who have been following that, was rolled out, where that was, and there's no judgment here on my part, but that was rolled out very quickly, and perhaps necessarily so, in order to get funds to small businesses as quickly as possible. And so necessarily some of the rulemaking and process around putting that program in place was not as deliberate as the Main Street Lending Program rollout has been. The Main Street Lending Program had a 3-week gap between the announcement of the preliminary terms and then the near final terms, and they did reflect feedback from the market, and there's still further rollout coming in the form of making sure that's a good process in place with the originating banks before they set a time frame when the applications will start coming in. And by contrast, the PPP was, here's the date, and we're gonna work backward from there to get things ready for accepting applications, and the bank struggled with that quite a bit. So hopefully this process that the Fed is rolling out will be a little bit more predictable than the PPP loan origination process, and the FAQs that they've published will hopefully help guide potential borrowers through that process. So I don't see any questions for the group to address. We do appreciate everybody joining us this morning. Chelsea or Loic, did you have anything you wanted to say before we signed off here?
I just want to say thank you guys for joining us, and like Erik said, if you guys have any questions, let us know. But thank you for getting up with us this morning and hearing about these new developments.
Same. Thanks, everyone, for joining us.
Yeah. Thank you all. Have a great day.